Joining us now is BeiChen Lin, Senior Investment Strategist and Head of Canadian Strategy, Russell Investments, here with reaction to today's jobs report. BeiChen, thank you so much for joining us today. All right, let's talk about these jobs numbers. The headline number, according to the Labor Department, the economy grew by 139,000 jobs in May. That was better than expected. Unemployment rate holding at 4.2%. That's in line with expectations. What's your reaction to those numbers?
I think overall what today's U.S. non-farm payrolls report shows is that the economy held up pretty nicely, even though we are in this environment where there's just so much macroeconomic uncertainty. So against that backdrop, I do think it's encouraging to see that job creation overall came in a little bit better than expectations, especially because earlier in this week we had the weekly jobless claims come in a little bit harder than expected, as well as some soft ADP data as well.
Yeah, that ADP data was concerning. The market managed to shake it off because in recent years those reports have diverged. But there was that question, and would we start to see more parallels? Would we return to years past where ADP was essentially a signal to the non-farm payrolls report? I'm curious to know your thoughts on this. Healthcare added 62,000 jobs in May. That's higher than the average monthly gain. What's your view on what that means?
Well, so far what we've seen is that a lot of the job creation has been driven by healthcare. And if you think about what happened during the pandemic, a lot of nurses, a lot of doctors, they left the profession. And so as a result, healthcare was one of those industries that really had to catch up in terms of rehiring people back into the field. And that catch-up process is not fully complete just yet. So that's been one of the reasons why healthcare has been leading the charge. But I think it's also important to focus on the other sectors as well. And when we look at job creation today in 2025, it's a little bit more broad-based than in 2023 or 2024. Still being led primarily by healthcare, leisure, hospitality, but at least a little bit more broadening out. So that's been encouraging.
Leisure and hospitality was the second area where we saw a strong growth there, up 48,000. That was actually largely in food and beverage places. Does that line up with what you've been paying attention to in terms of the patterns?
So one of the key watch points for us is really on the consumer, because against this backdrop of macroeconomic uncertainty earlier in this year, what we've seen is a pattern where some of the consumer survey numbers have come in a little bit softer, followed by a rebound in sentiment after some of the trade deals were announced between U.S. and key trading partners. But during that time period, even as we saw some consumer confidence measures start to tick down, what we saw was that overall consumer spending still held up. And so against that backdrop, I think it's reasonable to see that employment in food and beverage is still holding up nicely.
Okay, yeah, and it just shows that, although it seems to be the consumers being choosy, the consumer is still out there to a certain degree, and maybe that's because they just still have a job.
And I think that's exactly right. When we look at the broad consumer base as a whole, what we're seeing is that there is that story of resilience. Now, there are pockets within the consumer, such as the lower income consumer, where we're seeing a little bit more strain. And that's one of the reasons why we at Russell Investments, even though our base case is for a soft landing, for a recession to be avoided, we do think that macroeconomic risks are still a little bit above average.
And when you say macroeconomic risks are still a little above average, where are you seeing the cracks?
Great question. So it's on the lower income consumer, and you also have to remember that even though the Federal Reserve has been gradually lowering interest rates over time, interest rates right now are still above what we call the neutral rate of interest. So they're still weighing down on the economy, and we expect that the Fed's next rate cut might not come until September.
Okay. I think that lines up with where I've seen a view. So what do you think between now and, I don't know if anything could shift the timeline that many see for the Fed and just policy implications?
At the end of the day, the Fed, like many other central banks around the world, they're all going to be data dependent. So it's really going to depend on what inflation does, what the labor markets do. I think one of the important things to emphasize is that in recent days, we've been hearing speeches out of some Fed officials where they've been saying they don't necessarily need to see tariffs go all the way back down to zero before they can start cutting rates. Rather, it's more about the clarity. As long as they have confidence that even if we have a little bit of tariffs, as long as they have confidence that inflation expectations over the medium term can stay well anchored, then they can still be in a position to potentially cut rates. If we look outside of the U.S., we've seen other central banks actually have to step in and cut rates more aggressively. One of the reasons for that is because when we think about the impact of some of this trade policy uncertainty, it's been weighing more on growth in places outside of the U.S. than compared to within the U.S.
So I'm curious to know your views on this. So average hourly earnings on a year-over-year basis were up 3.9%. That was higher than expected, but what's interesting is that is something that lines up with what we saw from ADP. They saw an increases in wages on a year-over-year basis, whether it was people who stayed in their job or job changers. Obviously, it was more for job changers. What does that signal to you about any inflation risk?
Well, I mean, at 3.9%, I think the risk of an overheated labor market is fairly low. 3.9% is generally in that sweet spot of what the Federal Reserve can tolerate. If we started to see wage inflation grow to around 5 to 6% like we did have during the aftermath of the pandemic, that's when I would get a little bit more concerned that perhaps we might see some stickier inflation pressures. But for now, 3.9, I wouldn't say it's something to be alarmed by.
Okay, we'll have to leave our conversation there for time. Thank you, BeiChen.
Thank you so much.
Appreciate it. That's BeiChen Lin, Senior Investment Strategist and Head of Canadian Strategy, Russell Investments. Our thanks to BeiChen.